The U.S. crude and natural gas industry has been undersupplied for quite some time. So we've been really undersupplied relative to history from about 2015 and on. What I'll do in this video is we'll talk a little bit long term about the oil and gas industry. We'll talk about Russia's recent selling to India above those price caps. And then I will give a price prediction for natural gas and U.S. oil. So with that being said, let's dive right in. So this chart here shows me the rig count for U.S. crude oil and natural gas. So we can see that we're right basically below those 2018 highs at around a thousand rigs in operation. So currently we're at about 647. That was the most recent number in August. So unfortunately, obviously these rig counts are down massively, especially as global demand for oil and natural gas really skyrockets. So this signals to me that there is a undersupply of U.S. crude throughout the market, U.S. crude and natural gas. So that really sets up a environment where prices are likely to continue higher. And then let's take a look at OPEC's cuts. So this shows the monthly oil production for OPEC. And we can see here that it's been steadily declining since September of 2022. And we're really, right where we were in 2021. So that leads me to believe that OPEC could cut supply even further to drive up the price of oil and, obviously make more money for the oil that they're selling. And then let's take a look. How important is Saudi Arabia? So 13% of 13% of the world's total oil supply comes from Saudi Arabia. Iraq makes 5%, China makes 4%, United Arab Emirates is 4%. So it's definitely not a drop in the bucket. But we can also take a look at Russia. Russia makes up 10% of the world's oil supply. So they're definitely very, very important in that aspect. And then the U.S. makes up 21% of the world's total oil supply. So the fact that U.S. rigs are dropping is definitely significant and really does drive up prices long term. So we talked about Russia making up 10% of the world's total supply. Let's take a look at this recent story that Russia is selling oil to India at $20 above price cap. So Yellen and the G7 had set a price cap for oil and gas, or excuse me, just for crude oil. And they set it at $60. So that means anyone who's buying oil from Russia must only pay $60. But the issue is we're seeing countries like India come in and pay $20 above that price cap. Well, when you accept a $90 or excuse me an $80 per barrel cost for oil, well, what you're doing is you're driving up the price of oil, right? Because you're paying more than we should be for Russia's oil. So what this does is it just kind of exacerbates this move higher that we're seeing in energy prices, right? We're not able to get cheap energy from Russia. That's just not happening. They're not selling it for that $60 price cap number. They're not accepting that as a price. They're obviously charging more, and people are paying it, right? India is a huge country, and they just paid $20 above that price cap. Pretty disrespectful to Yellen and the G7, and I think this kind of shows you that people are really starting to care less about what the West kind of imposes on them, right? I mean, they pretty much just kind of spit in the face of the U.S. and the G7 by paying $80 a barrel when all the G7 countries agreed to pay $60. So the issue with this is once one country breaks, it really will cause a domino effect, and I expect some more countries to come in and pay higher than that $60 cap price. So unfortunate to see that India has kind of broken ranks here and is buying oil from Russia above that price cap, which should kind of push oil prices higher. But what we just talked about was a bit more long-term structural issues within the oil market. What we're about to talk about now is the short-term price movement of oil and gas. Where do I think U.S. crude is going? So I think U.S. crude is likely to move lower from $94, as this is where we topped out on Wednesday and Thursday's trading session. We topped out around this level and moved lower, and this level is significant as it's also where U.S. crude had topped out in November and in October, which leads me to believe that we'd likely see a move lower off of this resistance level. So obviously momentum has been quite bearish for crude, but shares are also pulling back from overbought levels according to RSI, which leads me to believe that we'd likely move down to the 50-day moving average, which coincides with support at around $83, which is where shares had topped out in April, in February, in January, in December of last year as well. Past resistance acts as new support. So I believe this $83 level, $84 buy range acts as support as this coincides with the 50-day moving average. So I think we see a short-term pullback over the coming days, and we kind of bottom out at about $83 as momentum is quite bullish, which should help kind of keep oil prices high relatively. We had the 50-day moving average cross above the 200-day moving average in late August, which is known as a golden cross and signals bullish momentum. And then we can also see that the worst couple months here for the oil market is October, November, and December. So October is the second worst month in oil's history. So 77 years of U.S. oil trading data here, and on average, shares decline. Not shares. This commodity declines 1.2% in October. November. Oil declines 2.2%. So this is definitely a bearish seasonal trend for oil here. And then let's take a look at natural gas. So natural gas just climbed back over its 200-day moving average for 3 trading days. This is the longest we've been above the 200-day moving average since August of last year. So this is the first time we've been kind of holding this 200-day moving average consistently for over a year, so definitely significant there. Also, we had the 50-day moving average cross above the 200-day moving average on Thursday, which is known as golden cross and signals bullish momentum. So I do think natural gas is likely to move higher as we kind of move into the winter here. Obviously, everyone's heating their homes, using natural gas for that. So that could obviously help natural gas move higher. And I think we likely get a move up to about $3 for natural gas, which is where natural gas had pulled back on August 10th. It's also where natural gas pulled back in early March. So I believe we see another pullback from this $3 level. But there's really 2 scenarios that could play out. Is that we get a pullback from that level, and we would see a move lower back to the 200-day moving average. So first scenario, we come up here, then we see a move back lower to the 200-day moving average around 2.7. Or we break this resistance level at $3, and we see a significant move higher for natural gas. Personally, I do think we could see some consolidation around this $3 level, but kind of long term, looking at a couple weeks here, I think natural gas likely breaks this resistance level at $3, and we see a move higher for nat gas over the coming weeks. So that's what I'm thinking. I'm thinking U.S. oil likely continues its pullback, and we see a higher move for Nat Gas over the coming weeks. So, but like I said, be on the lookout for that break of $3 for natural gas. Then my confidence level would shift significantly higher. That Nat Gas would move higher. So, with that being said, I hope you enjoyed the video. I will end it there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone. Happy trading, happy investing.